Hi everybody, it's Professor Olney. I decided to try to do a 30-minute video. The try is the 30 minutes because, as you know, it's hard for me to keep my talking down to just 30 minutes. I'm going to try to do a 30-minute video that gives you the monetary policy story all in one chunk. We've basically been unrolling it over about a 5-week period with a little bit of the story every day. And so I'm going to try to do just 30 minutes that captures the whole story all in once. And I hope this is helpful to you. Wish me luck in keeping this to 30 minutes. I've got my handy dandy timer here going, which will hopefully keep me on track. And yeah, so it's 4 o'clock on a Friday afternoon. But it's all good. Go Bears. We're going to win the Axe. It's all great. Okay, here we go. So let me start with this picture, which is the picture that tries to set out for you all of the various steps. So let me try to walk you through, and then what I'm going to, well, anyway, stick with me. Here we go. So the first step, we're going to start here at aggregate demand. And the first step, I'll call it step 1, is that aggregate demand affects output. We spent a long time on that. On talking about the determinants of aggregate demand. So aggregate demand is the C plus I plus G plus exports minus imports. And then how much aggregate demand there is determines how much output is going to be produced, because businesses are going to produce output in response to the demand for their products. That was step 1. We spent time talking about the determinants of each of consumption, investment, government, exports, and imports. What's going to be important for the story of monetary policy is the role of interest rates in determining investment spending and net exports, and maybe or maybe not consumption spending, maybe spending on durable goods. It's not obvious that interest rates affect consumption spending. I'll try to come back to that piece. Okay, so that was step 1 is that the amount of output in the economy, GDP, depends upon aggregate demand, C plus I plus G plus exports minus imports. And then step 2 is that the amount of output determines how much employment there is. So how many people can find jobs, how many jobs there are in the economy, that is to say what's total employment, that depends upon how much is being produced. So employment depends upon output. That's step 2. Step 3 is that once we know how many jobs there are, if we know what the labor force participation is, that is, we know how big the labor force is, then unemployment is determined by how much employment there is. So unemployment is just going to be the labor force minus the employment. That's going to give us the unemployment. That's a relatively straightforward, there's caveats in all of this stuff. That's a relatively straightforward piece, the link from employment to unemployment. The piece that we've just recently added is the piece that goes from employment to inflation. That, step 4 is the Phillips curve. I'm going to come back to that in a minute and fill that piece in. That's the Phillips curve. And then step 5, which I'll put as both of those arrows, step 5 is that the Federal Reserve, the central bank, looks at the values of unemployment and the value of inflation, both what they currently are and what the indicators are for what the unemployment and inflation rate will be over the next 2, 3, 4, 5, 6 months. And in response to that unemployment and inflation rate, the Fed sets interest rates. Now, what we've learned is the interest rate they actually set is the interest rate on excess reserves. They set that interest rate on excess reserves, and in the same breath, they say that they have a target rate for the federal funds rate, and given the way that the markets now work, once they set the IOER, that pretty much determines what the federal funds rate will be, and then they hope that all of these other interest rates change. And now that's going to bring us back. So here comes our big black arrow. That's going to bring us back. What am I on? Step 6. That's going to bring us back to aggregate demand, because the change in interest rates should then come back and affect investment spending, net exports, maybe consumption spending, we'll see, and that feeds back into unemployment and inflation. That's the general story, but there's so many steps in that, it's taken us weeks to unpack that. So I'm going to try to unpack the various steps in this story, and let me try to do it. I've got some notes here. See, I have notes. I have notes here, and let me go by my notes because I do have some slides set up to go with this, and that will help us. And then I'll come back to this at some point with my steps 1 through 6. Oh, I can't come back to my steps 1 through 6 because the way I'm annotating my slides, the steps 1 through 6 will disappear. Well, in any case, I'll come back to the idea. It'll all be good. You'll be with me. It's all happy. It's almost Thanksgiving. It's big game week. This is all going to be great. Okay, so the first piece I want to talk about is the Phillips curve piece. So let me figure out how I go to the next slide. That was not it. I think I have to change this to an arrow. And nope, that still isn't it. Aha! And then I have to erase. There we go. All right, the Phillips curve. The Phillips curve is a relationship between the unemployment rate. So I'm going to put the unemployment rate down here on the, I'm out of space, unemployment rate down here on the horizontal axis. And at least the way it's traditionally drawn in the United States, the price inflation rate. So we're measuring price inflation with, for instance, the percentage change in the CPI. We could use the percentage change in the Consumer Price Index excluding food and energy. We could use the percentage change in the PCE, the Personal Consumption Expenditures Index, Price Index. We could use what you did in the problem set, which is the PCE minus food and energy. Any of those are fine. Any of those are giving us what we want, which is a measure of the rate of change of prices. Okay. The Phillips curve relationship is essentially a downward sloping relationship. I'll label it PC. That downward sloping relationship comes from essentially two steps. One step is the amount of unemployment in the economy is going to determine the rate of change of wages. And the second step is that the rate of change of wages, that is to say what we pay workers, is going to determine the rate of change of prices. So there's two steps to this Phillips curve relationship. That's going to become important in just a sec. This is what I went through in class, at a really high unemployment rate, lots and lots of people unemployed, wages don't increase very fast, and if the unemployment rate is really, really high, we can get wages dropping. If wages are increasing only, say, 1% per year, that means that the costs of production are not increasing very fast because most of the costs of production are caught up in the labor costs. That means that the costs of production are not increasing very fast, like 1% per year. To the extent that the prices we pay are a reflection of the costs of production, then the prices we pay are going to increase maybe 1% per year. So that would be something like, here we are at unemployment rate A, which is a relatively high unemployment rate, and that's associated with a relatively low inflation rate, like inflation rate A. On the other hand, suppose that let me change colors. I love being able to change colors. It's like, it gives me joy. Suppose that the unemployment rate was far lower. Suppose we had like 3.7% unemployment rate. Suppose the unemployment rate was much lower, so like the example I did in class where it was just the GSIs who didn't have a job. If the unemployment rate is much lower, then that's going to lead to pressure for wages to increase for the reasons I went through in class. That when there's not very many workers available to hire, bosses are going to offer raises to the people who work for them, and they're going to try to bid the existing workers away from the jobs that they have by offering them higher wages. That increase in wages as unemployment goes down, that's increasing the costs of production, and as the costs of production go up, so like now costs of production are going up, say 5, 6, 7% per year, that's going to get passed on in the form of higher prices for the goods that we buy. And so at a lower unemployment rate, like a 3.7% unemployment rate, we're going to have a higher inflation rate. And so that gets me a point like B on my Phillips curve. So that's the standard explanation of the Phillips curve. Why is the Phillips curve downward sloping? It's downward sloping because of this relationship from unemployment to wages and from wages to prices. Okay, some logic to that. I'm going to come back to the caveats to that in just a second. We move along the Phillips curve if there's something that is changing aggregate demand and causing a change in the unemployment rate. So movements along an existing Phillips curve come from changes in aggregate demand, which go back to the previous picture, changes in aggregate demand which change the unemployment rate, move us along the Phillips curve. There are things that can shift the Phillips curve, And we usually talk about just 3 things that can possibly shift the Phillips curve, although I think that we probably are going to add a 4th, and that if you look at a textbook when you're a parent and your kid is taking economics, there'll probably be a slightly different explanation of the Phillips curve in that textbook. This is why your parents want to see your textbooks, you know. It's okay. It gives you something to talk about at Thanksgiving, you know. Okay, anywho. So things that can shift the Phillips curve. Let me see what's on my next slide. Sorry. How do I change slides? I think I have to go to the arrow, and then I go to this one. There we go. Ooh. And then I erase all of that stuff. Okay. So if I just draw one dot for each year. So for instance, this is the unemployment rate. If I dash that down, there's the unemployment rate in 1980, and I dash it over. And there's, yes, indeedy, up at like 13% is the inflation rate in 1980. And then here is 2019. So there's the unemployment rate in 2019, and dash it over. There's the inflation rate in 2019. So that's what each of these dots is, the value of unemployment and inflation in that particular year. Now, if there was just one Phillips curve, like I showed you on the previous slide, then we'd be able to draw one, really, seriously, we'd be able to draw one line that would do a good job of fitting all of this data. Well, it would have to be really thick, right? So it has to be a line at this point that's like a thick line, like that. So thick, 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 T-H-I-C-K, thick. A very thick line. That's useless. I mean, if that's the relationship between unemployment and inflation, that's a completely, utterly useless relationship to use to set policy. So that's not good. So it must be either there is no Phillips curve relationship, we don't really believe that, or the Phillips curve can shift. Because if we look at this, and particularly if we do the connect the dots thing, we can see that there appears to be a Phillips curve way out here, and then there's another Phillips curve that's in here someplace, and then there's another one that's getting kind of fuzzy that's in here someplace, and then there's another one that's in here someplace. That there seem to be several different Phillips curve. So there's something that's causing the Phillips curve to shift. Okay, now let me go to the arrow. Let me go here. There, okay. One of the things that can cause the Phillips curve to shift is our inflationary expectations. Let me first show you a picture. Oh, that's funny. It's not supposed to be there. Let me erase that. There we go. Okay. So here's our Phillips curve. Excuse me. Unemployment rate on the horizontal axis. Inflation rate. Sorry about the pen being kind of clunky. Inflation rate on the vertical axis. Let me see if I can change the width of my pen. There we go. Thin. Okay. And so here's my initial Phillips curve. I'll call it PC1. Let me just choose some point. I'm just going to randomly choose a point A on my Phillips curve, dashing it down. It corresponds to unemployment rate A, dashing it over inflation rate A. And that's just some random point on the Phillips curve. All right. Suppose that there is an increase in inflationary expectations. So inflationary expectations, I'll write it that way. Inflationary expectations is, what do you expect? What do you think the inflation rate will be next year or the year after? But let's just go with next year. So you say to somebody on November 21st, yesterday, what do you think the inflation rate is going to be in 2020? And they say, 2%. That's their inflationary expectation, the expected value of inflation for 2020. Suppose that you asked a bunch of people yesterday, what do you think the inflation rate is going to be in 2020? And they all said, 2%. And then you go back and you ask them today, and events have happened in between yesterday and today, and you go back and you ask them today, and you say, what do you think the inflation rate is going to be next year in 2020? And they say 5. I think it's going to be 5%. You know, yesterday I said 2, no more. Now I think 5. Now I think the inflation rate is going to be 5%. That's an increase. We call that an increase in inflationary expectations. So the answer to what do you think the inflation rate, that's terrible. Inflation rate in 2020, what do you think it'll be? And the answer, it had been 2%, and now it's 5% because 5 is greater than 2. I'm really sorry about the, I wonder if I can, oh, there's an eraser. There. Let me try to write that again. Because 5 is greater than 2, that's better, that means that there's going to be, that we call that higher inflationary expectations. Well, what happens? If all of the workers, excuse me, if all the workers, this is no way going to be 30 minutes. Sorry. If all of the workers think that inflation next year is going to be 2%, so you think the inflation rate, oh, now that's too thin, isn't it? You think the inflation rate is going to be 2% next year. There. You think inflation is going to be 2% next year. Then if you get offered a raise that is, say, a 3% raise, that'll make you happy. Because at least with that raise, it's not a great raise, I got to tell you, but it beats inflation. So you get 3% in your increase, your wage increase or your salary increase. You can buy everything you bought this year plus a little bit more because you've beaten inflation. But now suppose that your inflationary expectation, so what you think the inflation rate is going to be next year, is 5%. Now if the boss offers you a raise of 3%, you're going to be unhappy because you're not even going to be able to keep up with inflation. I mean, 3 is better than 0, don't get me wrong, but 3 isn't going to allow you to keep up with inflation. And so because your inflationary expectations increased, and because this answer increased, you're no longer as happy with that 3% raise. So workers, to the extent workers have power, so there's also some bargaining power issues in here, workers go to the bosses and say, no, you're not giving me a 3% raise. I want to have at least a 5% raise. I need to be able to beat inflation. Bosses don't like giving raises, but they do like keeping their best workers. So the bosses also have this new answer. That's a key assumption, that both the workers and the bosses share this new assumption. The bosses also have this new answer to what they think the inflation rate is going to be next year. And so when you go to the boss and say, 3% isn't going to allow me to keep up with the cost of living, I'd like to have at least 5, maybe a 6% raise next year. The bosses are like, okay. I mean, if I increase the wages of my workers by 5% or 6%, given what's happening with inflation, I can increase the price of my products by, say, 5%. I'm not going to lose market share because 5% is what everybody's going to be doing next year. So, okay, fine. So what happens then is that when the inflationary expectations increase from 3 to 5, what happens is workers want a higher raise and bosses will give a higher raise. And so now all of a sudden these raises become 6% and everybody's happy again. So what happened? At the same unemployment rate, so unemployment hasn't changed. There's no change in unemployment in my story. Now that particular any unemployment rate along this horizontal axis is now going to be associated with a higher inflation rate because the expectations of prices have gone up, so wages have gone up, and they're going to pass that on in the form of higher prices, which is going to make the inflation rate go up to match what people thought was going to happen. So the entire Phillips curve, there we go, good job. The entire Phillips curve shifts up as a result of that increase in inflationary expectations. So one of the things, and the one I'm going to emphasize in the video, I'm going to leave the others to class because the others don't matter as much for what we want to talk about. One of the things that really matters for shifting the Phillips curve is what's happening with people's inflationary expectations. Okay, so what do we know about inflationary expectations? So this is from Fred. So I just pulled it off of Fred. You can do the same thing. Go on Fred and type in inflation expectation or inflationary expectations. And what you can see is this is a survey that the University of Michigan does of consumers. There's another way to look at inflation expectations that looks at the expectations of the people who invest in stocks and bonds and so on. And you can see that, here we are. This is today. I pulled this up yesterday. There was a spike here in inflationary expectations in about, looks like 2011. But generally, inflationary expectations for the most part have been what they call anchored, stuck. I don't know why they call it anchored. I don't know why they don't just call it stuck, but they call it anchored. Inflationary expectations have generally been anchored at about 2%, between 2 and 3%. So this is 2, this is 3. Inflationary expectations are well anchored at 2 to 3%. The Fed likes it when inflationary expectations are well anchored, that is when they're stuck at 2 to 3%, because back here in the 1980s, when inflationary expectations were very, very high, that was one of the periods when, remember, that's one of the periods when that Phillips curve shifted out. So if I, let's see, if I go back, I have to erase all these pictures. Let me go back. Hush. There, go back. So see here, here's that 1980s. Oops, go back. There. Here's that 1980s and also the 1970s when those inflationary expectations had risen, and you can see that's when that Phillips curve had shifted out. And then when the expectations of inflation shifted back down, the picture I showed you starts in the 1970s, but what essentially happened was expectations by the mid-80s in the 90s got back to where they had been 1950 to 65 or so. The Phillips curve shifts back to essentially where it had been in the 1950s and early 1960s, when at that time as well, inflationary expectations were on the order of 2 to 3%. Okay, now if I do this, will it, oh, it changed, awesome, yay. Okay, now, one of the puzzles. So I said that there are two pieces to the Phillips curve relationship. There's the unemployment to wages piece, and there's the wages to prices piece. This picture that I'm showing you right here, this picture is showing you the price inflation. So this is the percentage change in P, and I just used the CPI to do this on the vertical axis. And as it says, the unemployment rate on the horizontal axis. If I play dot to dot, for which I need my glasses, here's 2010, 2011's up there, let me skip that for a minute. 2010, 2012, 2014, where's 2015? It's down there, weird thing, skip it. 2016, 17. So it looks like, if you just do the dot to dot game from say 2010 and you ignore 2011 and ignore 2015, you get essentially this horizontal line, right? So it's looking like, if you look at recent data, it's like, what happened to the Phillips curve? It looks like if we drew a Phillips curve, right? If I just drew a Phillips curve, so I had unemployment and inflation, it looks like the Phillips curve has now gotten essentially flat, right? So either flat like this, or maybe honest to goodness flat. Whoops. Oh, that was not a very good erasing it, was it? Hold on. Erase. There. Let's see. There. Maybe honest to goodness flat. So looks like the Phillips curve now has this flat. What the heck is going on? Well, remember the Phillips curve has these two steps, unemployment to wages and wages to prices? Well, let's look at the first step. Let's look at unemployment to wages. No. Poop. Erase everything. There we go. So here we've got the... I'm trying to rush through this on a Friday afternoon, so I'm like being weird. It's okay. So remember, we had unemployment to wages and wages to prices. And the unemployment to prices piece looked horizontal. Here's unemployment to wages. So this has the percentage change wages on the vertical axis, and again, unemployment on the horizontal axis. That looks sweet. That's exactly what we would expect. There's a downward sloping Phillips curve. So what's broken down over the last decade is not this relationship between unemployment and wages. That seems to be perfectly fine. The unemployment to wages relationship still has that downward sloping relationship that Phillips predicted in the first place. Remember, that was what Phillips had worked on, was just unemployment to wages. What's broken down is the link between wages and prices. Personally, I think, I told you I just hit the mic, sorry. I told you there's three things. So the one I talked about here was inflationary expectations. Another one is, oh my God, I just forgot what they are. Changes in the prices of key inputs like oil, and changes in the rate of growth of labor productivity. Those are the three factors we're going to talk about that shift the Phillips curve. I think this piece, like why has the relationship between wages and prices broken down? I'm going to bet you and you can come back and find me when I'm 82 and tell me if I was right or not. I'm going to bet you that in 20 years, what's going to be in the textbooks is a discussion of globalization and competitiveness and the ability of firms to increase prices without losing market share, because that's their big worry, and that their ability to increase prices without losing market share is not only about what's happening to inflation, but it's about what their competitors are doing. And so if a US firm is operating in a competitive environment on a global basis, and if the costs of the US firm are going up, but the costs of their competitor who's in another country are not going up, that's going to limit the ability of that firm to increase its prices, because it'll lose its customers to the alternative source. That's my hunch. So it's not yet in the textbooks. It's my hunch as to where the literature is going to go. Check it out when you're a parent and your kid's taking a principles course. That better not be in 20 years. That better be in more like 30 years, just saying. But anyway, I think that's where we're going to go. But it's right now, this is a very hot topic of research to try to figure out what's happening to the Phillips curve. Okay. All right, let me erase that. Let me see what's on my next slide. Okay. So let me go back to, let's go by title, go back to the stepping back slide. All right, so we had aggregate demand, pen. Life is just too crazy. We had aggregate demand to output. That piece was pretty straightforward. Output to employment. We don't talk much about that in Econ 1. I'll talk about it more in 100B. It has to do with a relationship that's called Okun's Law. It has to do with what's happening with productivity, but we're just going to assume that there's a nice, smooth correlation between output and employment. Employment to unemployment, as I said, unemployment is going to be the labor force minus the amount of employment. And so the only way that there is a problem in terms of this linkage between employment and unemployment is if the labor force is changing at the same time. So like employment goes up and the labor force goes up at the same time, and so then unemployment doesn't change. Or employment goes down and the labor force goes down at the same time, and so unemployment doesn't change. But by and large, there's a nice, easy relationship between employment and unemployment. And then this link here between employment and inflation, or I suppose between unemployment and inflation, that's what the Phillips curve was all about. So this piece here was the Phillips curve piece. Okay. So now we've talked about that. So I'll put a little check mark. Done. Okay. Let me jump to the relationship between interest rates and aggregate demand. So the Fed is going to change interest rates, and that's going to change aggregate demand. And let me go to one of these whiteboards again. Ooh, isn't that pretty? I think I can get a new one. Nope. There. Ooh, new page. Okay, cool. So interest rates to aggregate demand. Aggregate demand. I don't know why the pen is not as good as it was the last time I did this. C plus I plus G plus exports minus imports. Let me see what happens if I go here. No, I'm not want to go there. Okay. Investment, there's the investment. Investment, remember, is businesses' construction expenses plus purchases of machinery and changes in inventory holding, which we don't have to worry about because they're not a big part of the story except very, very rarely, and not for us to worry about in this semester. The investment projects, because it's construction and long-lasting machinery, are multi-year long projects, and so they're going to borrow over a multi-year long period. And that means that what's relevant to investment spending is largely long-term interest rates, borrowing for 3 years, 5 years, 10 years, 20 years, something like that. That's why the yield curve is relevant and important to look at, because the yield curve tells us about the relationship between short-term rates and long-term rates on any given day. The notion is, we know that what the Fed does is the Fed sets the IOER. The Fed has a target for the federal funds rate, which it announces at exactly the same time in the same press conference that it announces the IOER. And then the Fed crosses its fingers and hopes that these changes in the IOER and in the federal funds rate will lead to changes in the long-term interest rates, the interest rates that businesses will pay in order to borrow to finance this investment project. Okay? So the yield curve, that's what captures this relationship between the short-term and the long-term rates. Yield curve. We put the term down here on the horizontal axis and interest rates up here on the vertical axis. And so I could go on Fred and I can look up interest rates today. And it used to be you could go to treasury.gov. You can still go to treasury.gov and look up interest rates on any given day. It used to be that you could go to treasury.gov and they drew the graph for you. They don't do that anymore. So put 3-month rates down here. I can't believe I'm getting a text. We get 3-month rates, 6-month rates, 1-year rates, 2-year, 5-year, 10-year, 30-year. It's usually not drawn to scale. I don't know why. And the interest rate's up there. And so it's actually a collection of dots. So here's the 3-month interest rate, and here's the 6-month interest rate over here, and so on. But they always connect the dots, you know. And so we get this curve, which is, say, suppose that's the yield curve for today, which is the 22nd. And so if I dash up, that yield curve is telling me that the interest rate today to borrow for 10 years is represented by this dot here. I'll give it a name. Dot A is telling me, why not, is telling me the interest rate to borrow for 10 years. Dot, go up from 1 year. Dot B is telling me the interest rate to borrow for one year, and so on. Yield curve. A normal yield curve is upward sloping, the way it's shown here, because the long-term rates are going to be above the short-term rates, even if we don't think short-term rates are going to change for the next 10 years, because there's a term premium, I get some extra for tying my money up for 10 years, and there's a risk premium, I get some extra because I don't actually know what interest rates are going to be over the short-term interest rates are going to be over the next 10 years. I'm making a guess. You know. And so the more uncertain I am about my guess, the more of a premium I want for being willing to tie my money up long term, because I was shooting in the dark. I didn't really know what I was doing. Okay, so that's the yield curve in any given day, on any given day. And then what happens is the yield curve, if all the interest rates go up and down together, then the whole yield curve shifts up. So the yield curve would shift up. And this would be a yield curve on another day. So suppose interest rates were higher on, let's say, October 1st. And so all of the interest rates, the short-term and the long-term rates, were higher on October 1st. And so you'd have a yield curve that was above this one. And then sometimes we get a yield curve that's called an inverted yield curve. And an inverted yield curve is one that has short-term interest rates above the long-term interest rates. Inverted because just imagine if you had a mirror here in between the blue and the red lines, and you had a mirror, and that's an inversion. That's what they call it. The slope is inverted because it's negative instead of positive. Okay, anyway, it's an inverted yield curve because an inverted yield curve has the short-term rates bigger than the long-term rates. That's really weird. So you can get an inverted yield curve for one of two reasons. One possible reason for an inverted yield curve is because the short-term rates went up, and that's how I drew it here. I drew it where the long-term rates haven't really changed, but the short-term rate went up a lot. And that would happen if, for instance, the central bank was conducting contractionary monetary policy, if they were increasing interest rates in an effort to fight an inflation, so they knew they were creating unemployment because they were going to march down the Phillips curve, they would raise the short-term rates in the hope of throwing people out of work. I mean, that's what they're trying to do. Decrease aggregate demand, throw people out of work, create more unemployment, takes pressure off of wages, takes pressure off of prices, brings the inflation rate down. That's one reason to get an inverted yield curve. The other possible reason, though, to get an inverted yield curve is sometimes you get an inverted yield curve not because the short-term rates have gone up, but because the long-term rates have come down. So for instance, if the inversion looks like this, So this is also an inverted, I don't know why the pen is being so funky today. This is also an inverted yield curve. And in this case, if this inverted yield curve was, what happened on the 23rd, that's a Saturday, that's big game, we're going to win the axe, it's not going to invert the yield curve. Wouldn't that be funny? Anyway, not if we won, but if it inverted the yield curve. The inversion of this yield curve is saying, look, there's no change in the short-term rates. The Fed hasn't changed policy. What's changed is the long-term rates. Remember that, where am I going to write this? Remember that this long-term rate is equal to the average of today's short-term rate, so the short-term rate today, plus the future expected short-term rates over the same time period. So if we're looking at the rate for a 10-year treasury, then these expected short-term rates are over this same 10-year time period. So they're like every 3 months over that 10 years, plus the premium, plus the term premium and the risk premium. So if the yield curve inverts because the long-term end comes down, what that means is something has happened to either lower the premium, the term premium, not likely, the risk premium, maybe heightened certainty lowers the risk premium. But more likely what's happened is something has happened to lower these future expected short-term rates. That's what we saw a year ago. So a year ago in fall 2018, when you look back at the old midterm questions, there's a question about the inversion of the yield curve. And I think it was, it could have been in the 100B exam. I think it's the Econ 1 exam. I'm not sure. I'm pretty sure it's the Econ 1 exam. The yield curve inverted because the long-term rates came down. The long-term rates came down because the expected future value of the short-term rates came down. The way to understand why people suddenly revised their future expectations, so what they thought the 3-month rate would be in 2028, requires us to talk about one more concept, which I'm going to cover on Monday, the 25th, which is called the Taylor rule. So let me play here. I'm really sorry this is going so long, but you expected that at the very beginning, right? Because I just rattle on. Okay, so let me go to... I have to erase all these things. Taylor rule. Okay, Taylor rule. The Taylor rule is a way of thinking about, is there anything systematic or predictable in what the central bank chooses as their target for the federal funds rate? So it's an equation. It's an equation. Looks like this. It's an equation that says, yeah, there is. There is some predictability to what the Federal Reserve does in choosing its target for the federal funds rate. Now, in the graph I showed you on the very first slide, it said they're going to look at, don't do that to me. There. It said they're going to look at the unemployment rate. Right? There was one circle that was unemployment. They're going to look at the unemployment rate and the inflation rate, and they're going to take both of those into consideration when they set the target for the interest rate. Right? That's what my little graphic said. That's exactly the same thing as what this equation says. This equation says that they're going to set the federal funds target, this target value for the federal funds rate. Let me come back to the neutral rate because that's really important to what I was just saying about the yield curve. By starting from something that's called the neutral federal funds rate, and I'll come back to that in a minute, and then they're going to compare what their goal is for the inflation rate with what the inflation rate actually is right now, and if the actual inflation is bigger than the goal rate for inflation. So if the inflation rate is too high, then that's going to lead them to increase interest rates. They're going to try to fight the inflation. So this is a plus A, so that's why this is a plus here. Now this version, there's two versions. This version of the Taylor rule expresses the Taylor rule in terms of the inflation rate and the percentage change in GDP, the rate at which GDP is growing. So remember, before this unemployment, we had employment, and before employment, we had GDP. If GDP is going up, unemployment's going down. If GDP is going down, unemployment's going up. So the second piece of this Taylor rule says they're going to compare the actual rate of growth of GDP with their goal for the rate of growth of GDP. I'm really sorry about this pen being so wonky. They're going to compare the actual percentage change in GDP with their goal for the rate of change of GDP. And if the actual is bigger than the goal, so if the economy is growing too fast, right? The economy is growing at 5% per year instead of their goal, which is around 2.5% per year, that means that unemployment is like going down really fast, or unemployment is too low relative to their goal. And in that case, they're going to slow down the economy by increasing interest rates. You have to be able to tell the stories about why and how interest rates affects investment spending, and why and how interest rates affects investment spending, why and how interest rates affect net exports. You got to have those stories down. You got to have them cold. And so that's why there's back to where I was. So the reason there's a plus in front of the B over here is because if the actual GDP is bigger than the goal for GDP, they're going to increase interest rates, a plus. And you can flip these inequalities over. If the actual inflation is less than the goal inflation, they're going to decrease interest rates. If actual GDP is less than goal GDP, they're going to decrease interest rates. And that's what this equation says. Now let me see if I can hit yes, awesome. Let me erase things that are in my way. That's in my way. That's in my way. Okay, let me erase this because this is kind of in the way. I can also express the Taylor rule with inflation and unemployment, and this is the version that corresponds directly to this picture that I had on the very first slide about unemployment and inflation determine the target value for the interest rate. Okay, so now they compare the actual and the goal inflation rate, the actual and the goal unemployment rate. Notice the sign here has flipped because as GDP is going up, unemployment's going down. And so if they want to bring down the unemployment rate, they're going to bring down, let me restate that. If the actual unemployment rate is above their goal, so if there's an unemployment problem, they want to lower interest rates because they want to help expand the economy. Okay, so this is called the Taylor rule. And I think I have it again on the next page, so let me go to the next page. Good. And let me erase all this stuff. Awesome. Okay. The neutral federal funds rate. Think about it. I'll tell you about it. Sorry, that was rude. If the actual inflation rate equals the goal for the inflation rate, then this difference here between the actual inflation rate and the Fed's goal for the inflation rate, then that difference there is going to equal 0. I don't want this version. Hold on a second. Here, let me play with this version. Okay, this is still true here. If the actual inflation equals the goal inflation, then the difference between actual and goal is 0. 0 times A is 0. Okay? If the actual unemployment rate equals the goal, the Fed's goal for the unemployment rate, then this difference between actual and goal, if those two things are equal, then this difference here is equal to 0. That's a 0. Anything times 0 is 0. And so what we have is that if the actual U equals the goal U, if the actual inflation equals the goal for inflation, then the target for the federal funds rate is going to equal the neutral value of the federal funds rate. That's the definition of the neutral value. So the neutral value of the federal funds rate is what would the federal funds rate equal if unemployment and inflation were both at their goal. So if we were at 2% for inflation and 3.5% to 4% for unemployment, kind of where we are right now, what would the federal funds rate be? Okay, so now back to the issue about the yield curve, and so here's term down here on the horizontal and interest rates up here on the vertical, and this is the yield curve. That's a C. I hate this pen. And the yield curve going from an upward sloping, I'll call it yield curve 1, to an inverted yield curve 2, which happened a year ago. I think it was last December. When people are forming those expectations of what the short-term interest rate will be in the future, you're sitting here the weekend before Thanksgiving in November of 2019 trying to think about what are the interest rates going to be in 2023, 2024, 2025, 2026. You know that the interest rates, that the Fed is setting the interest rates using some sort of a Taylor rule like this, where they're taking unemployment and inflation into account. You could sit here and you could try to make some guesses as to what unemployment's going to be in 2023 or what inflation's going to be in 2023, but you don't know. I mean, it's like putting on a mask and throwing a dart and hoping you hit the donkey on the tail or whatever that game was. And so what typically happens is that when we're forming those expectations for interest rates in the far future, what we tend to do is we assume that the economy will probably be at full employment, that will probably be at the target for the inflation rate. And so we use this neutral, what people do is they use that neutral federal funds rate as their expected value for the future short-term rates. So what do I think the short-term rate is going to be in 2023? Whatever the neutral federal funds rate is. What do I think the short-term rate's going to be in 2024? Whatever this neutral federal funds rate is. Because on average, over time, over a decade-long period, we may go above it, we may go below it, but generally we're going to have an interest rate that more or less is at that neutral rate. So what happened when the yield curve, I wish I could just erase a line the way I can with my... Okay, what happened when the yield curve dropped like this? Well, what happened when the yield curve dropped like this was Chairman Powell we had taken interest rates up, I think it was when we'd taken interest rates up to 2.5%. So the nominal federal funds rate was at 2.5%. And by and large, most people in the business world thought that we were heading up to about 4%, because if you look at the federal funds rate and you look at what it had been in previous periods, we had typically gotten back up to around 4%, 4.5%, 5%. And when it hit 2.5%, he had a speech where he said, more or less, he says, yeah, we think we're pretty much there. We think that we are at the neutral rate. Oh, so the neutral rate's not 4, the neutral rate's 2.5. Well, if the neutral rate is 2.5 instead of being 4, that lowers all of those future expected short-term rates. That brings down today's long-term rate. And so you saw this inversion of the Phillips curve, sorry, my bad. You saw this inversion of the yield curve as a result of Powell's speech. That's really interesting. That was so interesting. Because usually people say, oh, inversion of the Phillips curve. Darn it, it's not the Phillips curve. Start over. Usually people say, oh, inversion of the yield curve. Bad, bad, bad. That means there's going to be a recession. Yeah, usually they say that because most inversions of the yield curve happen because the Fed increased interest rates. And when the Fed increased interest rates, they did that in order to create a recession. So yes, most inversions of the Phillips curve that are driven by increases on the short-term end of the most inversions of the yield curve, I don't know why I keep saying Phillips curve, most inversions of the yield curve, which are typically driven by the Fed increasing the short-term end of the yield curve, are indeed an indicator that we're going to go into recession, because that's exactly what the Fed's trying to do. But the most recent inversion of the yield curve happened not because the short-term rates went up. It happened because the long-term rates came down. The long-term rates came down because of this change in the future expected short-term rates. And what happens when long-term rates come down? When long-term rates come down, all else constant, you have to know this story, that triggers an increase in investment spending. And so instead of the inverted yield curve being a sign that, oh, we're going to have a recession soon, batten down the hatches, instead, that particular inversion of the yield curve was actually good for investment spending because it lowered the interest rates that are relevant to businesses when they're undertaking investment spending. All right. Now, let me look at my notes and see if I have talked about all the things I want to talk about. There was one more thing I wanted to talk about, and that was the zero lower bound. So let me see if what's on my next slide. There it is. Whoops, there. Aha, good. Okay. So here's the graph. We can look at this graph and we can see what is the Fed, more or less, what's the federal funds rate that the central bank has set. You can see it was up here at 6.5, and then they brought it down, and then they took it back up to 5.25. So that was the old neutral rate, was 5.25, and then it was at 0 for a really long time. And then they took it up, but they stopped at 2.5%. And that was where what I was saying was people had expected they would continue to take it up to at least 4, but they stopped when it was at 2.5%, and then more recently they've been bringing it down. This period here is when we hit the zero lower bound. So I talked about the zero lower bound in class on Wednesday. The zero lower bound is the notion that is being abandoned around the world, is the notion that there is some minimum value for the federal funds rate, and that minimum value is 0. That if the central bank takes the federal funds rate below 0, that essentially all HE double toothpicks is going to break out. I would normally say that word, but you're probably going to show somebody this video, and I don't want to say it on the video. The notion is that if we go into negative interest rates, that a whole lot of trouble is going to break out. And so that's why the zero lower bound, which is to say having a minimum value for the federal funds rate, has been set at 0. The experience of all those countries that I listed on that slide on Wednesday that have taken their central bank rate, their equivalent of the federal funds rate, into negative territory, and the fact that none of those places have had the sort of financial crisis that everybody anticipated would happen if they went to negative interest rates, gives our central bank confidence that if they can take interest rates negative, so that here, let me erase and start over. So that they could have actually taken the interest rate down into the negative territory. So here's -1 down here. And that it would not have triggered a huge financial crisis. Now, I don't know if that's true or not. And I don't know if the experience of a small country like Sweden actually tells you what's going to happen if this is done in the United States. We're a much bigger player on the world's financial markets, the United States is, than are most of those countries that were on that list that I showed you on Wednesday. But nevertheless, the central bankers are thinking about, wondering, planning for, crossing their fingers, trying to figure out if it would be possible to take interest rates negative when we go into the next recession. Don't know the answer. Don't know if it'll work. All right, so let me see if I have told you everything I want to tell you. So let me go back to the first slide. By title. Stepping back. Okay. So what do we got? We've got C plus I plus G plus net exports. That's the aggregate demand piece. And once again, I did that. There. That's the aggregate demand piece. And you should be able to tell me the story about C, what determines C and I and G. Well, not G. G just comes from the government. C and I and exports and imports. And the multiplier story. And what changes the size of the multiplier. Because all of those pieces go into determining how much output there is if there's a change in aggregate demand. The amount of output determines how much employment there is. And we're just going to take that as a straightforward correlation and not worry too much about the caveats on that one. The amount of employment in the economy determines how much unemployment there is, and related to the Phillips curve, also determines the inflation rate. There are problems, right? We know right now that the change in unemployment, oh, that looks terrible. We know right now that a change in unemployment is still giving us the change in wages that the Phillips curve predicts, but it does not seem to be giving us the change in prices. That piece is not happening. So that's the puzzle with regard to the Phillips curve. The Federal Reserve, our central bank, looks at the unemployment and inflation rates and compares the actual values of these things with the goals that the Fed has set for unemployment and inflation. And in light of any differences between the actual and the goal levels of unemployment and inflation, the Fed sets interest rates, and we capture that relationship between actual unemployment, actual inflation, goal inflation, and the interest rate target. We capture that with the Taylor rule. Once they change the interest rates and they change the IOER, that's what they can do. And in the same press release, so make sure you look at that press release I wanted you to look at for the problem set, they change the target for the federal funds rate. And then they hope, fingers crossed, they hope that that changes the long-term interest rates. And then that combination of changing in very short-term interest rates, which might affect what's happening in financial markets and therefore exchange rates and therefore exports and imports. But more importantly, these changes in long-term interest rates are going to feed back into aggregate demand and help the Fed to achieve whatever goal it's trying to achieve with regard to unemployment and inflation. I told you I couldn't do it in half an hour. It took me 53 minutes. But I hope it's been helpful. It's taking that entirety of things that we've done. It's really like a 5 or a 6 week excursion that I tried to condense into one short video. Not so short, but anyway, it's okay. So I hope that's been helpful to y'all. Have a fabulous Thanksgiving. I will see you Monday. I'm still here Monday on the 25th. I'm here Monday. You're here Monday. We're all here Monday. And then we go for Thanksgiving. And so I hope you all have a fabulous holiday. Eat a little bit too much. Be nice to your relatives. They're really happy to see you. If you talk with your family about economics, they're going to, especially with whoever's paying the bills, they're going to be like, oh, wow, look at that. Our kid came home and now they're so smart. It's really actually kind of fun. Gives you something to talk to your Uncle Art about at the dinner table. So give a shot at that as well. And I'll see you I'll see you Monday, 25th, and then I'll see you when we all get back in the first part of December. So have a great break. I don't know how to stop this thing. Oh, I know, I remember now. Have a great break and have a great holiday. And tomorrow's the big game, so go Bears. I want to see that axe on Monday. Go Bears.